At the basis of investing is having the ability to read through a company's financial reports. I'll be honest with you and say that you'll probably not find this part too interesting, but it actually turns out this is probably the most important lecture. Knowing the ins and outs of financial statements is actually what distinguishes great investors from mediocre ones. I'll try to simplify things and leave out some of the more complicated terminology throughout this lecture. So, let's dive in. As we talked about in the IPO lesson, every public company is required by law to report and disclose its financial information to the public. In the United States, all the information is available on the Securities and Exchange Commission's website. The Securities and Exchange Commission, or SEC, is the main organization charged with regulating the financial markets. They're kind of like a financial police, and they aim to make investing as fair as possible. As you can guess, to make informed investment decisions, you'll ideally need to go through the material a company publishes to really get a grasp of what it does and how it performs financially. Financial reports might seem incredibly complicated, but it turns out they are relatively simple if you understand their overall structure and some of the more complicated words they use. The important thing for you to remember is that every financial filing is split into three key sections: the balance sheet, the income statement, and the cash flow statement. So, let's start with a balance sheet. This basically consists of assets and liabilities, and applies to companies as much as they apply to us personally. Anything that has value is an asset, whether it's a computer, a house, clothes, or a book. Liability, on the other hand, is a debt or obligation. This can include your credit card bills or student loan debts. When you subtract liabilities from assets, you will get your personal net worth, which are the net assets. Your personal net worth is just as important as the net worth of a company. However, investors typically never refer to a company's assets minus liabilities as net worth, and they instead use a fancy word called shareholders' equity. A balance sheet is important for many reasons. It can give an investor an easy look at how a company manages its finances. To illustrate the example, let's look at a company called Banana Motors Production, run by a CEO named Steve. Banana Motors is a startup automobile manufacturer. To better understand the situation, let's dig into the details of Banana Motors' balance sheet, starting with its assets. Something you'll notice in every financial statement for any company is how there are two columns with figures, in this case 2015 and 2014. This is mainly done by the company to help investors look at how a firm progresses over time and year by year. Assets are split into three main categories: current assets, other assets, and property. All of these add up to the total assets. Current assets are anything that are valuable and can be converted to cash quickly and within 1 year. Obviously, cash is the most important current asset, but there are also other things, like marketable securities, which can be shares the company owns that can be sold immediately for cash, as well as inventories. So, the two cars Steve built. Adding them up would give you $500,000, Banana Motors' total assets for 2015. When comparing the company's performance to the previous year, you'll notice that its assets have shrunk year by year. To find out why, look no further than the inventories, where you'll see that the value has fallen from $300,000 to $200,000. From that, we can figure out that Steve sold one of his cars for $100,000. At the same time, we see that cash has gone up by $50,000. So we can tell that Steve kept half of what he made from the sale of the car and spent the other half. Now, let's take a look at the company's liabilities. Liabilities are split under three key sections: current liabilities, long-term liabilities, and deferred income taxes. Current liabilities are the same as current assets, except while current assets provide value within a year, current liabilities are obligations that have to be paid within a year. So, while one adds, the other subtracts. Current assets are made up of accounts payable, which are things Banana Motors still has to pay for, like tires that are used for the car, payroll, which is the salary Steve pays his employees, as well as taxes, which are pretty self-explanatory. Total liabilities have increased by $5,000 due to a rise in short-term expenses. So, why are large liabilities bad for a company? Well, in Banana Motors' case, the firm is very limited in what it can and can't do. It's like if you personally took a loan to buy a house, so a mortgage. If you had to make consistent payments back to the bank, you wouldn't have the freedom to, for example, switch to a nicer but less safe job. A lot of debt restricts people and companies alike and prevents them from expanding, not to mention that too much debt decreases profits. The last part of a balance sheet is actually shareholders' equity, but through our discussion we will cover this. Alright, let's review Banana Motors' balance sheet. As assets have gone down, liabilities have moved slightly higher year over year, which is negative for the business. That said, given how large assets are relative to liabilities, it shouldn't be anything to worry about in the short term. As long as Steve is able to keep up production, he should continue to thrive. Let's move on to the next section. The income statement is the second part of a financial filing and contains two key metrics for an investor: revenues and expenses. While the balance sheet is a measure of the company's overall strength, the income statement gives an investor a better understanding of how the company is receiving and spending the money it has. The revenues of a business are what it takes in, and the expenditures are what it takes out, so costs. If you want to figure out whether the company can grow in the future, this is where you'll get that information. The income statement also indicates one of the most important measures for an investor: earnings. As we have already talked about several times, at the end of the day, it's all about earnings, and especially earnings growth. A stock cannot advance without the underlying business earning more money. In the income statement, earnings are listed as net income. To illustrate the income statement, let's use a pizza restaurant chain called Pizzaland. Please do keep in mind, however, that each of the three parts of the financial statement is interrelated. The revenue part is pretty simple. The company generated $500,000 through its stores, which is $100,000 more than the year prior. Expenses are listed as operating costs and expenses and comprise of restaurant-related expenses as well as general and selling expenses. As we can directly see, there has been an increase of $100,000 between 2014 and 2015, meaning that as revenue moves up, so do expenses. This is certainly not a positive thing, but is what happens to many businesses. In this case, we see most of the money is going towards employee payments, or payroll. A solution to this is to pay employees a constant amount. Last but not least, there's income. As you can see, there's a difference between operating income and net income. Amongst other things, net income takes into account the taxes a business pays. In this case, Pizzaland pays 50% in combined taxes and interest, which leaves it with $50,000 in net income. The real negative about Pizzaland's financial position is really that it is seeing no growth in net income. Someone like Warren Buffett or Peter Lynch would want to invest in a stable company that increases its profits over time. In this case, it's not happening. At the same time, if the management of the company can solve the issues of increasing labor costs, then net income will increase significantly. Only then would it prove to be a solid investment. The last part of a financial statement is the cash flow statement, and it is split into three main parts: cash flow from operating activities, investing activities, and financing activities. Overall, cash from operating activities is what is taken in, and cash from investing and financing is what is taken out. Let's take a look at the cash flow statements using another company called Blueberry Computers, which is a computer manufacturer. First off is the cash from operating activities. At the top we see net income, followed by the two main categories of cash provided by operations: charges and credits, and changes in working capital. Charges and credits includes things like depreciation, which is how the value of an asset decreases. Companies can write off a portion of that decline for tax purposes, which in turn increases their net income. Next are the changes in working capital. Accounts receivables are what the company is owed, and accounts payable are what the company still owes. Here we can see that cash decreases since someone owes $50,000 to Blueberry Computers. Something really important to note is that in accounting, whenever a negative number is expressed, we always use brackets, so the 50,000 is in fact negative. As we said earlier, cash flow from investing typically takes out money from a business, which is why the figures are negative. Capital expenditures refers to investments made on machinery for the business, in this case, automatic assembly lines to produce the computers. Investing is essential to keep a business up to date. Finally, cash flow from financing refers to how a business actually finances or funds its activities. As we looked at in the lecture on IPOs, businesses raise capital either by issuing debt or by issuing shares. Overall, Blueberry has seen an increase of 30,000 in cash outflows from financing from 2014. Overall, Blueberry Computers' cash flow statement proves that the business is stable and running smoothly. Though net income is staying flat, the business is investing more money for future growth, which is surely positive. Certainly, we would need to look at Blueberry's balance sheet and income statement to determine its worthiness as an investment, but based solely on its cash flow, you could expect that it would pay a large dividend, but wouldn't see much growth in share price. To sum things up, the balance sheet, income statement, and cash flow statement are all incredibly important and show different parts of a business's financials. While the balance sheet showcases what a business has through its assets and liabilities, the income statement focuses on how it spends its money through revenues and expenses. Finally, the cash flow statement shows how money moves in and out of the business. The ideal company would support many financial features, including high net income growth, a high level of assets relative to liabilities, as well as a high degree of cash inflows. In the end, these are the types of businesses worth looking into as an investor.